Have you ever wondered how the pandemic reshaped the rental housing market? With eviction bans and tenant-focused laws, landlords are finding themselves in a precarious financial situation. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. Let's get right to it. In a recent article titled "The War on Landlords," Stephen Malanga sheds light on the impact of tenant-friendly legislation that emerged during the COVID-19 pandemic. According to Malanga, these policies, while intended to protect tenants, have left many landlords, especially small property owners, financially vulnerable. During the pandemic, the U.S. government enacted eviction bans to prevent tenant displacement. However, these bans often did not distinguish between tenants who genuinely could not pay rent and those who could but chose not to. This resulted in significant financial strain on landlords, particularly those operating on thin margins in low-rent areas. Malanga points out that the eviction bans and subsequent tenant protections have not necessarily made housing more affordable. Instead, they have led to a reduction in real estate investment, a limited housing supply, and increased rents. These outcomes are contrary to the goals of tenant advocacy groups that lobbied for such measures. Research has shown that places with the strictest landlord regulations often see reduced evictions, but at the cost of a smaller housing supply and higher rents. This is particularly evident in tenant-friendly states like California and New York, where rent levels are among the highest in the nation. The article highlights the challenges landlords face, such as prolonged eviction processes and the financial burden of unpaid rents. In some cases, landlords have had to sell their properties, leading to a decrease in rental availability. Despite these challenges, there is a silver lining. Some local officials are beginning to recognize the unintended consequences of these laws and are pushing for reforms. Malanga suggests that with Donald Trump back in the White House, there is potential for change. The federal government could reassess these policies, focusing on encouraging voluntary participation in housing programs and tying federal housing funds to reforms that promote housing production. While the situation is challenging, it's an opportunity for policymakers to find a balance that supports both tenants and landlords. By understanding the delicate dynamics at play, there is hope for a more stable and affordable housing market in the future. As Canadians have just elected Prime Minister Mark Carney and the Liberal Party of Canada to lead the country, there's a sense of optimism in the air for the commercial real estate sector. Mark Feeder from Avison Young Canada provides a comprehensive perspective on what this means for the industry. He notes that Carney, with his impressive credentials, is well positioned to develop new trading partnerships and policies that could benefit the real estate market. Over the past few months, the uncertainty in leadership, compounded by tariff announcements from the United States, had put many commercial real estate decisions on hold. However, with Prime Minister Carney at the helm, both investors and occupiers in the commercial real estate market are expected to resume decision-making as the clarity of leadership is restored. The new government's approach to addressing tariffs and improving relationships with the American administration and other global trading partners is anticipated to provide stability and confidence in the market. In Alberta, for instance, while the pause in real estate activities was more due to the new government rather than tariffs, the election outcome is still significant as it influences policies touching the province. Despite the challenges that come with a minority government, Feeder sees potential for collaboration between Prime Minister Carney and Pierre Poilievre, as both leaders share some common goals. These include eliminating the goods and services tax for first home purchases under $1 million and reducing taxes for the middle class, which should stimulate consumer spending. The commitment from both parties to expedite major energy infrastructure projects and focus on efficient government management is expected to benefit the commercial real estate sector. Such measures could reduce red tape and bureaucracy, a move that's generally favorable for economic growth and real estate development. Looking ahead to the rest of 2025, the commercial real estate market shows signs of recovery. With low unemployment and controlled inflation, large and mid-cap companies are poised to make long-term strategic decisions. The new government is likely to boost confidence among businesses, encouraging them to invest in Canada and globally. Particularly, the suburban office market is a bright spot, with local private buyers showing increased interest due to the long-term potential at current valuations. Positive absorption in leasing markets indicates that more space is being leased than vacated, and the return to office momentum is strengthening. This presents a promising opportunity for patient investors. Let's turn our attention to an exciting development in the hospitality sector right in the heart of Ottawa. RIMAP Hospitality has just opened the AC Hotel by Marriott Ottawa downtown, marking the first of 3 new Marriott-branded hotels to grace the National Capital Region. This development is particularly noteworthy as Ottawa has not seen this type of hotel expansion in decades. The new AC Hotel is strategically located at 201 Rideau Street in the vibrant Byward Market District. This area is historically significant and is now home to a mixed-use development that includes the MRKT Lofts. The building features approximately 60% guest rooms and 40% rental apartment units, with tenants having begun moving in earlier this month. Mark Verratti, president of RIMAP Hospitality, shared insights on the development process, noting that the 14,000 square foot floor plate presented unique challenges. However, the team successfully integrated hotel and apartment services into the space, offering amenities such as electric vehicle charging stations, a swimming pool, a sauna, a gym, and 5 meeting rooms, alongside the AC kitchen and AC lounge. This is not RIMAP Hospitality's first foray into mixed-use developments. Their experience with the Hilton Garden Inn Montreal downtown and Le 400 Apartments has set a precedent for combining hotel and residential spaces effectively. This approach has become a hallmark for RIMAP, positioning them as a leader in mixed-use development within the hospitality industry. Looking ahead, RIMAP plans to open 2 additional hotels in Ottawa, the Moxie Ottawa Downtown and Major Apartments, and the Renaissance Hotel and OROS Apartments. These projects promise to revitalize the Byward Market area and Ottawa's financial district with new upscale accommodations and residential options. The combined investment in these projects exceeds $500 million and is expected to create 600 jobs. Verratti noted that these new hotels are poised to rejuvenate Ottawa's hospitality landscape, especially as some existing properties have become dated and less appealing. This significant investment is a testament to RIMAP's commitment to enhancing Ottawa's urban fabric. As we wrap up today's episode, it's clear that the hospitality industry is undergoing a significant transformation, with mixed-use developments leading the charge. These projects not only offer new opportunities for investors, but also promise to enrich the communities they serve. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. See you on the next one.